You've waited all week for the NFP breakout. You click buy at exactly 1.0850, but your terminal fills the order at 1.0858. An 8-pip fill error instantly shifts your risk-to-reward ratio. On a highly leveraged prop account, this gap can push the trade deep into the daily loss limit before the price even begins to move. The price flashing on your screen represents the top of book, the single best offer available at that specific millisecond. Because Forex is a decentralized auction, every transaction requires a matching buyer and seller. In a fast-moving market, the liquidity at your requested price often vanishes before your order reaches the network. Ignoring these auction mechanics transforms slippage from a technical detail into a recurring cost that systematically drains funded accounts. To understand why the price moves, we have to track the signal's physical path across the globe. If you are trading from Sydney, your order packet begins its journey right here. A standard home internet connection introduces roughly 200 milliseconds of latency. While that data is in transit, the global market can move several pips, leaving your requested price behind. By the time your packet reaches the institutional servers in London, the available liquidity has changed. Professional traders use a virtual private server, a computer hosted in the same data center as the broker, to reduce this transit time to under 1 millisecond. Once your order reaches the broker, it follows one of two internal routing paths. Under a market maker, or B-book model, the broker acts as your direct counterparty, taking the opposite side of your trade. These brokers carry the risk of your win, so they may use requotes to block your entry entirely if the market price moves against their own interests. In an A-book execution model, the broker strictly passes your order through to global bank liquidity providers without manual price interference. This choice of model determines whether your trade is filled fairly or actively obstructed by the house. When an order reaches the live liquidity pool, it must find a matching seller at the best possible price. Think of the depth of market as a vertical ladder, with different amounts of volume available at each price rung. Submit a 10-lot order when the best rung has 2 lots, and the system climbs the ladder to find the remaining 8, averaging higher prices. During news events, sellers pull orders, draining liquidity. This forces your fill price significantly higher to find a match. This works both ways. If the market moves in your favor during transit, a true A-broke broker will pass that price improvement to you, resulting in positive slippage. True slippage is the neutral mathematical result of your trade volume interacting with available market supply. For prop traders, these mechanical realities translate directly into your daily loss limit. A 3-pip slip on a 20-lot position is a $600 loss the moment you enter. If your daily limit is $1,000, you've lost 60% of your account's life to execution alone. Most firms include fair market value clauses to void trades that fill at unrealistic prices during extreme liquidity gaps. Trading without accounting for these specific firm regulations leads to preventable account breaches. To protect your capital, you can switch from market orders to limit orders, which prioritize your requested price over a guaranteed entry. You can also use the maximum deviation setting to create a digital boundary for your orders. By setting a 3-pip limit, you instruct the platform to only fill your order if liquidity exists within that narrow range. If the market spikes beyond that range, the platform automatically cancels the request, preventing a catastrophic fill. To see exactly how much slippage is affecting your bottom line, you can download the FXNX execution audit spreadsheet. Successful traders do not leave their entries to chance. They engineer their infrastructure to protect every single